You're listening to Fund Shack. I'm Ross Butler, and today my guest is Joanna Asfour, Managing Director Client Solutions at Partners Group. Partners Group is a true giant in the world of private market investments. Founded in the mid-1990s, it launched its first vehicles accessible to individual investors in the early noughties, which was some 20 years before most of the rest of the market. Today it has around 150 billion euros in assets under management, and private wealth is a very fast-growing part of that. Joanna, welcome to Fund Shack. Democratization has become the topic du jour, but as I've just said, it's not news to Partners Group. You joined Partners Group, I think, in 2011 from Citi Private Bank. So you know kind of both sides of the equation. And I guess, it's still a controversial topic to some degree, the democratization of private equity, but you see no, I assume, inherent conflict in individuals accessing private market investments.
Thanks, Ross, for having me. It's actually a really, really exciting time to be talking about this very topic. I think the term democratization has really been well coined in the industry and is quoted in lots of different kind of articles. But I think at its simplest form, it's really about broadening the access beyond institutional investors to individuals. And that can take the form of defined contribution pension scheme pensioners. It can take the form of individuals through their wealth management arrangements. And so there's been a lot of innovation in the market, but we really think it's about the mutualization of private markets, doing what mutual funds really did for public markets. Yes, there comes with challenges in terms of accessibility, in terms of communication around potential illiquidity in those solutions, but really at its simplest, we think that it is an amazing plethora of investment opportunities that should not be limited to sovereign wealth funds and the top tier institutional investors. We should be able to access this within a broader, diversified, risk-adjusted portfolio.
Like a pension portfolio
or something. Exactly.
So we've touched upon this topic kind of tangentially, let's say, on Fund Shack many times. I find it quite complex, and so I think you're exactly the right person to speak to. So I'm delighted you're here. But I wonder if you could take us through it, like, for example, segmenting the market. So in my mind, it's like, well, private equity, let's say, started out as just accessible to the big institutional investors. Is it as simple as this? Is there like a funnel? So you've got the big institutional investors, and then you've got really ultra high worth, very rich people, and then you go down all the way to like the retail investor. And is access to private equity going down that filter in a kind of a linear way? Is that what's happening?
I think that's exactly what's happening. I think we like to think of it more like a pyramid structure. At the top, you've got your institutional investors who've been accessing these asset classes now for decades because they see the benefits that private markets bring to their portfolio. Then if you kind of look at the next level down, the high net worth individuals have been able to access these asset classes through their arrangements with private banks. But then once we start to get smaller into kind of the small, medium-sized wealth management firms, many of them haven't been able to provide access to private markets beyond maybe a handful of the top tier one. And if we take just a slight kind of pivot toward pension scheme arrangements, there's been a real shift now from defined benefit pension schemes to defined contribution pension scheme arrangements, where the individual or a trustee board deciding what a default fund arrangement should look like on behalf of those DC individual pensioners. And so even that for us, we think goes down to making private markets accessible to the individual. So I do think it's a client segmentation exercise to take what is amazing investable opportunities and look at ways to wrap those in solutions that can be accessible for different client segments.
Right. So why don't we start? We've got to start somewhere. Let's start with DC pensions then. So I guess a lot of people listening to this and we're big fans of private equity, and we buy the kind of the risk return thing. And so you might think, well, trustees should just get into private markets because to some degree, it's a no-brainer. But when you look into it, it's complex. And if I were a trustee, I think I would be hesitant. And would I be right to be hesitant? How complex is this, and how do I approach it?
I think for me, it's less about the complexity of the asset classes, and the discussion has been more around the accessibility. So if we take on one hand, from a regulatory perspective, there have been very limited fund structures available in a UK authorised fund format that trustees could have invested in on behalf of their pension scheme clients, or decided that fund was suitable to be within a default fund arrangement. But in addition to that, it's also operational considerations as well. And the reason why those two merged between regulatory and operational was that many DC pension scheme arrangements are administered, if you like, or housed with life platforms, insurance platforms. And so a lot of those insurance platforms need that UK authorised fund structure in order to be onboarded onto a life platform. So for me, it's been less about the complexity, if you like, of the asset classes, and much more about how do you make this accessible on platforms so that DC trustees can think to even blend part of their default scheme arrangement into private markets.
So it's been a regulatory issue when you say UK authorised structures. Because of this intermediated phenomenon with the platforms, there needed to be the correct regulation in place.
That's exactly right. And recently the FCA have done a lot of work on looking at appropriate fund structures for the DC investment community. And this is where the LTAF, the long-term asset fund structure, was born. There was a group called the Productive Finance Working Group that was spearheaded by the Bank of England, by the HM Treasury, by the FCA, to really think through the operational barriers to making private markets accessible to DC investors. And one of those outcomes was to have this UK authorised fund structure, this LTAF, be the technical term is a conditional permitted LTAF, to allow these insurance platforms to house or onboard or life wrap those solutions onto their platforms. And now you have a fund structure that has been designed for this specific need, and we're seeing more and more private market managers innovate LTAFs, again, because of that new fund authorization.
So is the LTAF the go-to way of accessing private markets for UK DC schemes from now, would you say, or is it just one of many?
I think that's right. We ourselves have had a non-UCITS retail scheme operated as a fund of alternative investment fund. That UK authorised fund solution has been around since 2016. We were one of the first movers in that space. There, just as a side note, we were really taking private markets and putting that into a solution that was daily price, daily dealt. As you'll appreciate, it was complex to run for the asset manager. The end client had the same user friendliness as the LTAF. But what the LTAF has really done is allow more innovation, more asset managers, private market managers to design product that meet those LTAF requirements. So maybe breaking down some of the portfolio management or operational barriers to structuring an LTAF. And so we're seeing more and more LTAFs being launched in the market. And absolutely, I think a lot of discussion around whether, the allocations come to private market LTAF providers, or whether some providers want to design their own LTAF and have private market managers like ourselves provide content into their created LTAF. But certainly, as of today, that is the vehicle that is being kind of discussed very specifically for defined contribution pension schemes.
So just so I understand that, LTAFs are being created by both fund managers like yourselves, but also what's the other entity that could be?
So some master trusts have decided that they will create their own LTAF, their own long-term asset fund, and look to providers such as ourselves to provide the content into their LTAF as well.
Right. So Partners Group came up with a way for DC pension schemes to invest in private equity in 2016, but it was very complex. The LTAF structure is simpler, but it's not simple from a trustee's perspective, I assume.
I think From a trustee's perspective, I think there is still a lot of discussion around where to use the LTAF in terms of the glide path, how to use the LTAF, what are the benefits that the LTAF or private markets can bring. But from a complexity perspective, I think it's a much more simplified solution that trustees can access private markets in this way.
Okay, simple relative to how the world was, but simple relative to 60-40 equities and bonds?
I think that's fair. I think there's more discussion at trustee board levels around buy-in of what private markets can do to your portfolio.
A strong go-to-market strategy is key to success for any business. To do it well, though, requires the bringing together of diverse marketing skills, a knowledge of the latest distribution techniques, and a deep affinity with your business and its context. At Linear B Group, we make sure our clients in professional and financial services reach exactly who they want to in precisely the right way. This typically starts with your brand and messaging, your shopfront, and this informs the ongoing production of informative communications across the corporate calendar and down the buyer's funnel. And it culminates in a proactively managed demand generation or account-based go-to-market strategy. We don't produce content or thought leadership for the sake of it, and we don't create brands in a vacuum. Everything we do is part of a joined-up strategy that ensures you get in front of the decision makers, and the decision makers make the right decision. If you want to find out more, go to linearb.media or mail me directly. I'm Ross Butler, a Managing Director at Linear B Group, and like me, our team of technical marketeers, creators and editors know your market. We get you.
But I think there is a growing support that just for all the reasons that DB clients have been allocating to these asset classes for decades, the benefits that it can bring from a portfolio diversification perspective, from a outperformance perspective over the long term, from a lower volatility perspective. And really, yes, it requires more discussion by the trustees versus your 60-40 portfolio, but I think there's growing awareness of the benefits that can bring. I also think that the UK government have done a lot to showcase or to highlight the benefits of private markets, albeit maybe with a UK home bias. But I think all of that discussion has certainly helped to progress the discussion to having allocations to private markets because it is in the interest of better member outcomes.
I'm just trying to put myself in the shoes of a pension fund trustee, but I don't know any. So maybe you could help me out. What kind of people are these? They're not like full-time finance professionals or investment bankers, are they? Where are they normally coming from?
It's very varied. A lot of the trustees that we speak to who maybe have advised on DB pension scheme arrangements are also kind of trustees on DC, so they understand these asset classes. Again, I think it goes back to they understand the asset class, but they haven't been able to access these asset classes. But it certainly takes a certain type of trustee to kind of innovate and push the boundaries, especially when it comes to asking the life platform to onboard the fund. So a lot of these are kind of finance individuals. They're from industry. They're from, corporate. There's a lot of independent advisors out there today whose job is to help work with those kind of trustees to think about these asset classes. One other, I guess, important consideration is, the DWP came out with their disclosure explain policy, which really meant, have you thought about private markets within your portfolio? Can you disclose your asset allocation? And if you haven't got allocation to private markets, can you explain why? There was also a piece of work around, what's your policy on liquidity? And that was really to help prompt the discussion with trustees to think about actually what can less liquid asset classes such as private markets bring. Do you have a policy on liquidity? And all of these things were really to help prompt the discussion around the allocations to private markets. So there's been a lot of government support, I would say, for making these asset classes more accessible.
Okay, so I'm this trustee. I have some options. One option, I guess, is to do nothing, but it sounds like that's increasingly not an option, particularly in the UK, I'd say, because our public markets are so becoming so illiquid and declining. And there's the government, let's say, encouragement through the Department for Work and Pensions that they should be looking at private markets. There's a number of ways that they can access it, but you say that LTAFs are probably the way that most trustees will look at it. What's the next? So, and then they need to speak to their platform to get funds onboarded. But before that, actually, what's the next step? What are the key things that I need to think about in terms of diligence and understanding the risk and commitment, the government's commitment that I'll be taking on that I did not previously have?
Yeah, no, I think that's a fair point. I think first of all, it's thinking about where in the glide path of a pensioner's journey this sort of asset class sits. So a lot of discussion in the growth accumulation phase. What is it replacing? And at what point do you start tailing down your exposure to these types of asset classes pre-retirement, because inherently the underlying asset class is illiquid. So I think a lot of the discussion is about the design of the default fund, bearing in mind that there is actual inherent illiquidity within the asset classes. So the discussion around your policy on liquidity is an important consideration that these trustees have, and working with their investment consultants to stress test that liquidity profile. So I think that's part of it. I think
is that all about balance between liquid and less liquid assets? Is that and at different times in the pension journey? Is that what?
That's exactly right. I think also in a stress case scenario, if if a manager was underperforming, or if a manager had gated its fund, how long would it take for that default fund scheme arrangement to get their money out from that manager? And so a lot of the stress cases of what is the liquidity profile? How does the manager manage that liquidity? And I think, just as a side note, I mean, that is also why we were asked to get very involved in the Productive Finance Working Group at the outset, because we've been managing these evergreen fund solutions for the past 20 years. We've got a lot of experience on the liquidity management side, being able to weather storms like the global financial crisis, but even more recently, being able to allow for rebalancing during times of COVID, being able to satisfy redemptions when UK DB clients during the LDI crisis needed to redeem some of their private markets holding.
Can you give an example of a liquidity friendly term that you'd like, that you'd want to see?
Yeah, of course. I think with the LTAF, there is a lot of discussion around this 90 days notice. So providing the manager 90 days in order for them to really get organised in terms of providing liquidity back to the member. I think a lot of these LTAF scheme arrangements have a certain portion of liquidity in order to satisfy those redemptions. But I think it's also really important to make sure that your liquidity terms or your gating around that specific fund really matches the inherent illiquidity of the underlying asset classes. And that is a lot of the discussion or between the investment consultant and the trustee board to stress case the broader asset allocation, because we are obviously only part of the broader solution.
Yeah. How does the evergreen nature of these vehicles affect performance fees?
Yeah, so I think the performance fees do have to be structured differently. We've done a lot of work around the topic of treating customers fairly, because you've got investors, DC pensioners coming in and coming out at all different times. So if you imagine, you've got a pensioner kind of body. You've got, new individuals coming in. You've got other individuals kind of maybe transferring their corporate arrangement somewhere else. You've got people entering kind of retirement. You've got different people coming in and out at very different times. And how do you ensure that some I guess people aren't paying for performance fees on performance that they haven't earned, essentially. And so we actually take the view that
because they invested maybe after because there's a delay between the realization of that performance and the payment of the fees. Is that the problem?
So in a closed-ended fund format, you wouldn't have that. In an evergreen fund format, you need to make sure that the frequency of the performance fee calculation, in our view, happens on a daily basis.
Right, to account for that slight mismatch.
Exactly.
Although, just to play devil's advocate, if I was to invest in Shell and Shell spends loads of money investing in some massive project that doesn't actually pay off for 10 years, by which time I've already sold out. I mean, well, that's
timing consideration on your part. But I think from our perspective, I think we believe that that's the fairest way to reflect any net new performance that has been kind of generated,
fair enough,
and pay performance fee accordingly.
How do you achieve that? Presumably you've got to be constantly valuing.
That's correct.
assets.
And I think that goes back to the size of our platform and the operations that we have in order to take something that historically asset classes that were quarterly valued. As you mentioned, we've been doing this for 20 odd years in a monthly dealt kind of format, and so for us, taking those monthly processes and putting them in a daily process, we call it a daily valuation adjustment, taking that and just repeating it 28 times a month or 25 times a month was somewhat look, it was a lot of work, but it wasn't kind of impossible. And so for us, we calculate that performance fee. We calculate the entire fund on a daily basis, and I also think that is also why it has kept maybe some of the competition out of the market, because historically these funds have been kind of quarterly valued, but here you are with DC saying, hey, I need a daily price, my platform needs a daily pricing feed, and how do you achieve that in inherently illiquid asset classes?
Because to me that sounds like a big obstacle, but to Partners Group you've been doing it for years anyway, so you're already up the curve on that.
Yes, and I think for us it's important that there is you've got the backbone of operations in order to be able to do that. So that's why I think a lot of the single focused funds that maybe don't have the depth of platform don't have the people resources to kind of do that. So for us, for example, every single investment we will do FX on a daily basis. Any mezzanine loans, as an example, we will accrue interest on a daily basis. Any private equity companies that have suddenly kind of IPO'd, we will include obviously the listed price on a daily basis. So there are things that you can do on a daily basis to make your daily valuation as reflective of the broader market, albeit that there are illiquid private market assets in there as well.
So it doesn't sound like there are any actual technical structural obstacles left. This stuff's been solved.
We believe so. We've been doing it for a number of years. Yeah. I think why we are so excited now has been really about the credentialization of what we've been doing for years. We're seeing a plethora of managers come to market with either evergreen solutions. We're seeing more innovation in the LTAF space. As I mentioned, when we first started doing this for UK DC in 2016, it was quite a lonely place, because here we were innovating what hadn't been innovated before. And I think the more we welcome competition, because it sort of credentializes what we've been doing. I think in the next 2 years, a lot of this will have played out. You will have master trusts in the UK having decided
a master trust being a trust that manages multiple
DC
schemes.
pension schemes. Exactly. There's big consolidation going on in that marketplace, and as a side note, 13 of big pots of DC capital have also signed the Mansion House Compact, which is an intention to allocate 5% to unlisted equity by 2030. And so a lot of these master trusts are really thinking through their investment proposition to the market and how they will allocate to illiquids or private markets for the benefit of their members. I think there's a big piece there about cost versus value. A lot of these master trusts are still commercial master trusts who are out there in a very highly fragmented, consolidating marketplace. But many of them know that they need to work on their premium default offering, if you like, or in their already existing default to add private markets to those to their default kind of fund arrangement, because everybody is talking about private markets for the DC pension community.
Yeah, there's I guess a bit of a mindset shift required because of the intense focus on costs, which I think is probably justified, given that historically it's been a massive issue or determinant of returns, and with particularly like so-called active fund managers and the equity markets taking a fee for doing something that pretty much anyone can do with their own SIP. And so that would make a focus on costs in that context makes complete sense. But a focus on costs to the exclusion of the risk-adjusted return picture when you're looking at private markets suddenly looks more. Well, it's just like not comparing like with like.
I think that's exactly right. I think the focus on cost in DC specifically, you had the charge cap of 75 basis points, and I think it did a great job in terms of keeping everyone honest in terms of their fees and protecting those kind of DC pensioners. But I think also the behaviour that then it created was this sort of race to the bottom on fees. And again, as I mentioned, these master trusts are commercial and wanting to win business, and sometimes it can come down to a couple of basis points. And so there's a lot of there has been a lot of focus on what is your investment budget. Where are you going to spend those basis points, and what asset classes are you going to allocate to if you're trying to keep costs low? And I think that was identified as one of the key potential obstacles to actually people allocating to these types of asset classes that are inherently more expensive than say kind of equities and fixed income.
If you stand back, that's crazy, because the whole point of investment is to speculate to accumulate. The more you invest sensibly, the more you get back. And if all you're looking at doing is keeping your costs low, it's a race to the bottom.
I think that's exactly right. And so it's a big industry focus to really shift that discussion from cost to value, right, and what can we do to have better member outcomes net of fees. And we spend a lot of time speaking with trustees and investment consultants to say, the outperformance or the additional return, what that does to your kind of net returns. And yes, your TER will increase, but actually for the £100 invested, what can we provide as additional pounds to that retiring pensioner? So there's a lot of focus on the market on shifting that discussion.
I'm sure logic is on your side, but what are the kind of institutional blockers to winning that argument?
Yeah, I think firstly there's a lot of government support to try and shift that discussion. So there is the value for money framework that the FCA and TPR have been working on, but I do think it comes back to it's herd mentality. So if you can work with the large master trusts to think through that proposition, or with the large single employer trust-based DC schemes to have them demonstrate value, I think the rest of the market will follow.
Okay, where are we on the journey of getting of allowing DC pensioners access to private markets? Is there any way of quantifying it? What kind of proportion of are we tapping into at the moment?
Yeah, so I think the market, the size of the DC market in the UK will be probably about $1 trillion GBP by 2030. So from a private markets perspective, if you're taking, rough rule of thumb, 10% within a portfolio in the UK, this is 100 billion, opportunity. I think there's been maybe, call it 2, 3, maybe tops 5 billion that's been invested in this in the space so far. So we've got a long way to go until 2030. However, if you ask me in 2 years' time, I think there'll be significant allocations made over the next 2 years as master trusts think through their private market proposition and want to align with the Mansion House Compact by 2030. So for me, this is a very exciting and fast-moving time, certainly in the next 2-3 years.
That Mansion House press release put out by, I think it was Jeremy Hunt, that was pretty racy when it was saying about, the great promise of... I'm a big believer in what private markets can do for your portfolio, but they set expectations pretty high, I thought, in terms of what you're going to get for your money.
I think that's right, and I think we can't ignore the certain kind of political rhetoric and home bias, if you like, that has been discussed in relation to Mansion House. But I think what's been really helpful is to shine a light on private markets as a meaningful building block, as a mainstream allocation within your portfolio. I think for me, a lot of the UK investments that we do are really great engagement stories for those UK pensioners. They want to look and feel and touch and see the types of investments that they might be getting access to. But I think we are big believers in global diversification. So if the UK doesn't present good relative value, you want your asset manager to also allocate in other jurisdictions.
And there's no restriction to that other than the rhetoric.
That's correct.
Right.
And so I think, again, from a global perspective, we think it's in the interests of members and to achieve better member outcomes with globally diversified portfolios, albeit that UK investment examples are great engagement tools to communicate to your members.
So if we just finish off then, particularly on the DCs, is there anything else the trustees would need to think about in order to, appropriately assess this opportunity?
I think for some trustees or for some DC pension schemes, I think it's a decision whether they will stay as a single employer workplace trust-based scheme and be governed by a trustee body, or whether they will go to master trust. And so
Yes.
if they decide to go kind of down the master trust route, they may not want to or be in a position to make decisions around private markets because they may end up getting that through their master trust provision. If those single employer trust-based DC schemes have made a commitment that they do want to be in control of the destiny of their kind of pensioners, then I think, all the boxes are ticked from a regulatory perspective, from an operational perspective. And I think you will see more and more single employer trust-based schemes allocating to private markets.
Right. But there's also this phenomenon of consolidation going on, and you wouldn't want to be making those decisions if you were also thinking about consolidating. Is that what
That's
you're
correct. If you're thinking about going to the master trust arrangement, you might not want to invest in these illiquid asset classes in private markets.
I've had one or two guests on that have given a note of caution around LTAFs. It's what I alluded to at the start about retailization being controversial. And I think the concern is, well, these structures absolutely fine in the hands of Partners Group, but in a less reputable manager some point down the line, it could result in some kind of liquidity mismanagement that results in a blow up.
Yeah, look, I think that is fair, and I think that is a lot of the focus for the FCA when managers are applying to kind of create these LTAFs. A lot of focus is on the liquidity management piece, the experience in liquidity management and the tools that you will have to be able to weather storms, because there will be those events, market events, where liquidity will dry up in these vehicles. And so I think that's a real focus of the regulator, to make sure that the LTAFs that are launched are with reputable kind of managers. I think the other way to access this, huge opportunity that we see in the UK is to really, if you're a single strategy private markets manager, is to speak to those who are creating their own LTAFs and become a content provider to them, rather than manage your own LTAF, essentially.
Yeah. Where's the UK internationally on this?
Australia, I guess, are kind of leading the pack. They've been a big, all their large superannuation funds are defined contribution, and they are, everybody kind of looks to Australia. I think what's been really encouraging in the UK is the having all the stakeholders come together and really break down those barriers that have historically stopped DC pensioners allocate to private markets. And so when I speak to my colleagues in the US, a lot of them have regulatory envy about what we've been able to do as an industry, be that across asset managers, regulators, investment consultants, all coming together through the work of the Productive Finance Working Group to really tackle this. The other dimension is that, we see value in private markets, and we think that should be to the benefit of the UK pensioner, because the alternative is that there are lots of other pockets of capital all around the world, sovereign wealth funds, pension plans, really coming in and taking access to this investable universe. And we need to make sure that our pensioners in the UK also have access to that exact same investment content. And I feel really passionate about that, because otherwise, the rest of the world have these amazing investable opportunities, and yet in our own pension schemes, we don't access them.
That's a really good point. And I've never been a fan of the term democratization when applied, in a financial sense, because you think of, shareholder rights and so on. But in the way that you just put it, having like a stake in the economic success of your own country, or allowing some sovereign wealth fund halfway across the world to have the economic stake in it, that is where democratization of the asset class comes in. So it is, in some senses, quite a good term. What
has also been very encouraging is the work that recently went on to say that the LTAF is now the appropriate vehicle, or has had the sign-off from the FCA to be that vehicle for the restricted mass market, which will open up that potential vehicle for things like SIPs and other kind of pension provisions as well, albeit we're very early in that journey. And I think there'll be a lot of work around kind of innovation of technology in terms of how these wealth platforms actually access less liquid asset classes, because for the longest time it's been kind of mostly the UCITS funds.
And that would be the final missing piece in the pyramid we talked about at the beginning.
I think that's right. Yeah. I think that's absolutely right. I think from a wealth management perspective, I mentioned the tier ones have been able to allocate their clients to private market content and product. Private banks have accessed, whether it's kind of CCAVs, evergreen products, or through feeders into to managers, third-party managers. But I think it's the access to these asset classes through things like SIPs and your and ISAs that is almost the missing piece in the broadest sense of the democratization of private markets.
And what are we don't have to go into great detail, but what are the missing pieces to allow that to happen? What do we need to be looking at?
So I think technology is one thing. I think it's the innovation, and there's a lot of work being done on kind of wealth platforms and how the plumbing, if you like, works when things are kind of less less liquid. I think there's also a lot of consolidation going on in that market. You've got a lot of private equity backed consolidators consolidating wealth management shops and then thinking about what that proposition looks like.
So the private equity firms are buying the wealth managers and helping them structure better in order to invest in private equity funds.
I think it's not just private equity
No,
funds.
I know,
yes.
but I'm being glib. Yeah.
And I think the other aspect is suitability, right? And how do you ensure that these products are suitable for the end client? And how do you build, for want of a better term, a bit of a friction journey to say, are you aware of the risks and the illiquid nature of the of these asset classes? So thinking through things like suitability, thinking through things like consumer duty. I think there's more work to be done there, and I think that's what a lot of the wealth managers out there are thinking about.
What keeps you busy day to day at Partners Group?
Day to day, a lot of discussion with master trusts who are thinking through their private market investment proposition, thinking through proposals for them. A lot of discussion with single employer trust-based schemes who also sometimes just want to know and hear what other groups are doing, and a lot of time spent on proposals, a lot of time spent speaking with other market participants, because I think we see the value that the Productive Finance Working Group had when industry comes together to kind of push that agenda. Are
you surprised at how few of your peers are up the curve, or are they kind of rapidly catching up?
I think there are groups catching up. I think we've been operating in the UK since 2004. I think I wrote my first paper in DC in 2012 when auto enrollment came in, and Partners Group took a view, this is going to be a growing market. Now, you could argue we were probably too early to the game there.
Yeah, what were you doing for the first 5 years?
And so we've spent a lot of time on this. But as I said before, we welcome more and more market participants.
Yeah, the cake will get bigger, won't it?
Yeah. Absolutely. Yeah.
And sorry, just going back to your conversations with the master trustees or whatever they're called, what's the question that always comes up when you're meeting them?
The discussion is largely around fees still. So I would say it's about if they're trying to compete in a vastly consolidating marketplace, what is the additional value add? If their TER is going to go up, what is the outperformance that we can provide them? And that also is linked to the concept of thinking about private markets beta versus private markets alpha, and looking at private market managers who can really create alpha at those underlying portfolio company levels, and really improve those returns, because they're in charge of the destiny. They're sitting alongside management of those companies and making those companies better. There's a lot of discussion about how do you drive value at the individual company level? How do you create alpha? Again, because of that outperformance needs to be there versus public markets.
So they want to know actually how the magic happens.
Exactly.
Great. Well, thank you so much for coming in, Joanna, and explaining all that to me. You have to come back at some point, because this is a very fast-growing market. I want to know, how quickly this is all adopted.
How it plays out.
And how it plays out. Exactly. So,
Thank you very much for having me. It's a very, very exciting time to be talking about all of this.
For sure.
Thank you.
You've been listening to the Fund Shack podcast. Wherever you're listening or watching, please click follow or subscribe. That's all I ask. Thanks for listening.